everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser with Victory Fiduciary, and today what we just really want to get into is the fact that markets continue to be overextended, overstretched, and kind of really just stretched to the max at this point, especially when we look at things like divergence from their moving day averages and then, our profitability and earnings, and we're going to get into a couple of other things. But again, so just there's a lot of caution that's flashing right now when we look at just where the market is in terms of, how overstretched we are, how deviated we are, and kind of, how long will this actually be sustainable for. One thing that I wanted to get into is one of the technicals that we look at is money flow buy and sell signals. And so with money flow, that really just what we're looking at is number one, overbought, oversold, and then what is the likelihood that there could be price either reversions or that we continue to see prices rising. And so that will be typically, you'll see that rises and falls. When it turns, it's likely that we could see at least a short-term reversion in prices of stocks. This is the S&P 500. So we just hit a new high in the S&P 500 last week, and which I thought would happen. I thought that it was extremely likely. But what's interesting, we've obviously hit new highs before. This isn't the first time that we've hit a new high. That's what markets do. And so I wanted to go back in time here just to kind of show you, though, what's happened when we've been at a market high and then we've moved to a money flow sell signal. And so you can see every time here, so markets were here, money flow signal moved negative here, and we saw that correction here. Here, money flow sell, correction. Again, and sometimes they just come right back to their 50-day moving average, because remember, these are our lines of support, right? So again, here, sell signal, we saw that correction here. Here, this was back in February, so all-time highs in February. We were very extended above our 50 and 200 moving day averages here. Money flow sell signal here, and obviously that was a very significant correction there. So here we are here. We continue to be extremely extended and stretched above our averages. Remember, these moving averages, they act like a magnet, because for an average to work, we have to trade near them over time. And so what you can see is that we are trading above that, we're extended, and here and here. So here's our concern. So we haven't quite triggered a money flow sell signal yet, but we're close. And when that happens, combined to the extension that we have here, there is the potential for us to see a somewhat significant, at least short-term correction. So again, not saying it's going to be tomorrow, next week, next month. I'm just saying that what the technicals are showing us is that we could be setting ourselves up for that. It really wouldn't be that unlikely or unexpected when we look at, how fast, how far we've come without having a whole lot of real true support under it to kind of support the prices that we're seeing here. So just something to keep an eye on, things that we're watching as we monitor technicals. Something else that I think is concerning and worth mentioning is just the lack of breadth that we see across the actual index. So again, this is going to be the S&P 500. So here we are back in February, obviously the correction that we saw, and then this has been that recovery that we've seen. But what is so different now versus where we were in February is this was the percentage of S&P 500 companies that had new 52-week highs in that time period. So as you can see, we have a significant number of companies that are participating in this rally as we hit these all-time highs compared to where we are now. Significantly less participation across the broad index versus where we were before. And this is part of the reason for the concern in the fact that, we are so extended. We have so many kind of headwinds that still kind of face us in both the short and intermediate term, and we have very low participation. You combine that with what we talked about last week with the fact that volume within the market is significantly less than what it was. We're actually right now, our volume is 25% less than what we saw back even in April. So we have very narrow participation. Our volume in the market is significantly less. And yet here we are at an all-time high. And so it's just something, again, we just have to take pause with that and make sure that it's one of the facts that we kind of are taking into account as we create our portfolio allocations. So just something to be mindful of. Here, this chart, I'm not going to go through all of them, I'm just going to pick out a few. But what this really is, it's a chart, and it's basically, should we be showing caution or exuberance in the market. But just what I wanted to kind of show again in red here, these are going to be the areas of the market, and so these are just different sectors that we can participate in. And these are going to be the areas that are significantly trading above these areas of when we look at moving day averages. And so the S&P 500 right now is trading 7% above its short-term moving average, 11% over its long-term moving average. And then when we look at tech, tech is 11% above its short-term moving average and 22% above its longer moving average. Again, these are extremely extended. And so at some point, we have to see some sort of at least a short-term reversion to kind of like cool that off and bring us back down. And then when we look at industrials, they're also overextended, 7% short-term, 8% long-term. And so these are things, though, that we watch, because we want to make sure that when we are in a market, we don't want to be completely in an area that's overbought and overextended, because most likely that rally at some point is going to fade. And so, but it's not all bad news. So, you know, the math and rules-based program that we use, it doesn't just tell us where we need to steer away from, and it doesn't just kind of show us where we should have caution, but it actually also gives us entry points and allows us to see areas of best opportunity. And so we know where we should probably be avoiding, and then we also can see the areas of better opportunity. And so, because that's really what we want to do, that over the long term, we want to be able to outperform our indexes, and we do that by finding areas of positive relative strength and momentum. And so as of today, as we may even be doing it as soon as before the close of trading today, we are going to be adding 2 additional positions to our portfolios, which we're very excited about. And so I'm going to spend a lot of time on that next week, getting into those areas, why we chose them, and what that's going to mean for our portfolio. So I just wanted to kind of give that little snapshot. So I hope that you'll join us next week as we kind of get into that. But again, you know, like I said, again, the program that we use, it does give us caution. It shows us where we should stay away. But on the flip side, the good news is that we also have the opportunity to find where we should be entering as well. So that's all that I have for today. I thank you for joining us. If you have questions, you can always email me, ashleyr@victoryfiduciary.com, and we look forward to having that interaction with you. And again, I hope you join us. Make sure you're following us on Facebook and our YouTube channel so you get all of our updates. Thanks so much. Have a great day.